Hello and welcome to today's video. If you're stepping into the world of Forex trading, congratulations, you're about to embark on an exciting and rewarding journey. But let's face it, the Forex market can seem overwhelming at first, with all its unique jargon and concepts. That's why in today's video, we're breaking down the key terms every Forex trader must know. By the end of this video, you'll have a solid understanding of the foundational terms used daily in Forex trading, making it easier for you to navigate the markets confidently. And don't worry whether you're a beginner or just looking to brush up on the basics. This guide is for you. Also, be sure to check out the description below. I've included links to my recommended broker, known for their low spreads and beginner-friendly tools. And if you're looking for an easy way to access your trading profits, I've also linked a cryptocurrency debit card that you'll find super convenient. Let's dive in. 1. Currency pair. Let's start with the most fundamental term in Forex, currency pair. Simply put, Forex trading involves buying one currency and selling another simultaneously. That's why you'll always see currencies quoted in pairs, such as euro to US dollar or pound sterling to Japanese yen. The first currency in the pair is the base currency, and the second is the quote currency. For example, in the euro to US dollar pair, the euro is the base, and the US dollar is the quote. If the pair is trading at 1.1000, it means 1 euro costs 1.10 US dollars. Understanding this is crucial because the entire Forex market revolves around these pairs. 2. Pip. Next up, we have pip, which stands for percentage in point. A pip is the smallest price movement that a currency pair can make. For most pairs, 1 pip equals 0.0001. Let's say the euro to US dollar moves from 1.1000 to 1.1005. That's a 5 pip movement. Learning to calculate pips helps you measure profits, losses, and even risk levels in your trades. Think of it as the Forex trader's ruler. 3. Spread. Have you ever noticed there are two prices when you look at a currency pair? That's the bid price and the ask price. The difference between these two is called the spread. For example, if euro to US dollar has a bid price of 1.1000 and an ask price of 1.1002, the spread is 2 pips. This is essentially the cost of making a trade, and is how brokers earn their commission. A smaller spread means lower costs, which is why choosing the right broker is key. 4. Leverage. Now, let's talk about leverage. This is what makes Forex trading so attractive to many traders. Leverage allows you to control a large position with a relatively small amount of capital. For instance, with 1:100 leverage, you can control $100,000 in the market with just $1,000 in your account. But here's the catch: while leverage can amplify your profits, it can also magnify your losses. Use it wisely. 5. Margin. Closely tied to leverage is margin. Margin is the amount of money you need to open and maintain a leveraged position. Think of it as a security deposit your broker holds to ensure you can cover potential losses. Understanding margin is critical, because running out of margin can lead to a dreaded margin call, where your broker may close your trades to prevent further losses. 6. Lot size. When trading Forex, you'll hear the term lot size. This refers to the size of your trade. A standard lot is 100,000 units of the base currency. But you don't have to trade that large. There are also mini lots, 10,000 units, and micro lots, 1,000 units, making Forex trading accessible to traders with smaller accounts. Choosing the right lot size is a key part of managing risk effectively. 7. Stop loss and take profit. Next, we have two essential tools, stop loss and take profit. A stop loss automatically closes your trade if the market moves against you, limiting your losses. On the flip side, a take profit closes your trade once it hits your desired profit target. These tools are vital for managing your trades without constantly monitoring the market. 8. Bullish and bearish markets. You've probably heard the terms bullish and bearish. A bullish market refers to an upward trend where prices are rising, while a bearish market is the opposite, prices are falling. Recognizing these trends is essential for making informed trading decisions. Remember, the trend is your friend. 9. Forex broker. Your Forex broker is your gateway to the Forex market. They provide the platform and tools you need to execute trades. It's important to choose a broker with low spreads, reliable customer support, and a strong reputation. If you're not sure where to start, check out my recommended broker in the description below. 10. Risk-reward ratio. Finally, let's discuss the risk-reward ratio. This measures the potential reward of a trade compared to its risk. For example, a 1-to-3 ratio means you're risking $1 to potentially gain $3. A good risk-reward ratio helps you build a profitable trading strategy over time, even if you don't win every trade. Conclusion. Understanding these key terms is the first step toward becoming a confident Forex trader. From currency pairs to risk-reward ratios, these concepts will guide you in making informed decisions and managing your trades effectively. If you enjoyed this video, don't forget to subscribe for more Forex content. And as always, check the links in the description for my recommended broker and a cryptocurrency debit card to make managing your trading profits easier. Thanks for watching, and happy trading!